What's up, everybody? Michael and Coco here. You're watching the Stock Market Brief Show. Look at something big is taking place right now. Whether you're looking at yield curves, housing, lumber, or just the equity markets and or the dollar. Something big is taking place here. We're going to cover it on today's episode of the Stock Market Brief Show. If you're new here, welcome to the channel. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Today's episode is brought to you in partnership with FTX. More on FTX later. Let's get into it. Welcome back, everybody. We're looking at a heat map right here. Just wanted to call out week-to-date performance. Big moves in some of these tech stocks and consumer cyclical names. Apple was up 6.55%. Totally forgets how to actually have a red day. I think it's going on like 2 weeks of straight movement to the upside. Tesla was up about 12% on the week, so massive moves there. And then one to call out here in deep red is Home Depot. We're going to be touching on home builders here shortly. Now, if we look at year to date, they are pairing quite a bit of these losses, but some of the big names are still down pretty significantly year to date. Microsoft is down almost around 10%. That's one of those big market caps, but we've been seeing some price action that has been quite solid. Is it going to hold? Is that going to continue? We'll discuss it. Tesla is down 4% on the year. And then take a look over here at Home Depot is now down 25% on the year. Interesting. Now, if we take a look at Apple, that's what I mean by it forgot how to have a red day, just complete price action move to the upside. So at one point here, you would think that this is going to have a down day. We'll see when that actually is. It's interesting to look at charts like Apple and then charts like Tesla. Tesla's been making this big run up too, hitting that 61.8% fib level right there. Now it's having some inside trading candles, maybe gearing up for another move to the upside. I'd be surprised to see that. I guess I wouldn't be surprised because this stock has some crazy gamma squeezes. But just take note that the 10-year yield has been on a massive rise, and we're going to be discussing that. And typically when you get the rate at which these yields rise, it doesn't put that, it's not that great for, growth stocks. And we've seen, yields rise where growth stocks fall down, but we're not seeing that. We're seeing them move hand in hand. Interesting stuff, all right? So if we take a look at the week-to-date performance of the 11 sectors that make up the S&P 500, energy led the way, up almost 8%. Materials not too far behind. Then you have a defensive name in the top three. Utilities, what are the three horsemen doing? Well, that is financials, that is tech, and consumer discretionary. Where are you at? You're down here, all in the green on the week. Definitely tech and financials made a big move as well, up 2.22% for tech, 1.73% for financials, and consumer discretionary was up roughly about 1%. So big moves overall. Now, this is coming from the back of the VIX here, getting completely crushed to the downside, still remaining above that 20 level. Now, this to me is interesting, and I might go on a little tangent here, but it's interesting to see, sentiment. And by sentiment, I'm talking like, what I see. So a very small, small data point, right? I don't see much versus the market. But what I have been noticing here, if you've been paying attention, if you watch other finance YouTube channels like Meet Kevin, and all kinds of different ones. But when the VIX is trending high and when it's above this 20 level, and we're above 30 for quite some time here too. When the VIX is above 20, I noticed something very interesting take place in the markets. And what I've been watching here is a lot of people are getting thrown back and forth, and I feel like people are getting a little aggressive with one another. Sentiment gets a little rough. Like I'm starting to see more and more people take shots at one another. I'm seeing finance YouTube creators start to quit, and they're not like bad ones either. Pretty intelligent people, but the pressure when you start to see where I'm going with this is the pressure for creators and other people that are in the markets. When volatility is trending, when it's high, you get thrown around back and forth. This is why I always say the word, you got to be very tactical, because while volatility is up here above 20, and if it gets above 30, it's even crazier, right? Especially if it holds at those levels. But in this area over here, you got to understand that you need to be very tactical, because you're going to get charts that look like this. Boom, 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 boom. And during these moves, you're going to get people saying the bottom's in, right? And then it all of a sudden falls back out. And then they're going to say, okay, it's going to crash. And then the market rips. And people get thrown around, and then they get, you know, hate thrown their way, and you know, it's just a pretty crazy thing, especially for myself being in the space and being aware of it. So, you know, is volatility going to compress further? I don't know. I mean, it's still above 20 at this particular point in time, and charts look overextended, right? And if I look at this chart, what do you notice? Well, I see a low. I see another low. I see another low. I see another low. What do I notice about those lows? Higher low, still a higher low. So volatility is trending. So when you have trending volatility, I mean, what are you seeing out there, right? You have a high, another high, not quite another high over here, right? So volatility is currently trending right now, and just right now it's on its pullback. So, you know, as more bullishness enters in the market, Jim Cramer's saying that, you know, he's the bear market's over. Do we honestly know? No, and everyone's so focused on trying to be right and get the next move because, I mean, if you just look at what Hollywood has done to the market, and by Hollywood I mean look at all these movies like The Big Short, right? You know, Margin Call, Wall Street, all these movies, right, portray this lifestyle of, you know, you got to be right, you got to hit it, and then they can make a movie about you, and you can feel really good. But this game right here, when VIX is trending, stop worrying about being right, start worrying about the risk and being, you know, you can be right all the time as long as you follow your plan. The moment you break from your plan is when you're actually wrong. I'm going way off on more of a tangent that I actually wanted to go on. But volatility, still trending. CRB index, massive volatility. It was up 5.16% on the week. So, you know, we got some weird stuff going on. Markets are going insane. You got the indexes flying, inflation out of control. You take a look at oil. Oil is extremely volatile. That's a big component of the CRB index, right? Energy, agriculture. And you just see, like, look at these last 4 weeks. Like, something's up. Something's crazy, right? We have a lot of geopolitical risk at play right now. We're going to be careful. That's what I'm trying to say. Be careful. This is not a place to become a hero. And when you look at volatility as it's getting crushed and all this sentiment and people getting thrown around, where are we at in the S&P 500? Right? We're down 5% year to date. All right? So is it really worth it to be all crazy? All right? You know, there's all kinds of traders, and I'm doing the tangent thing again. You know, you have short-term traders, which are scalpers. They like volatility, but you get whipsawed a lot. You got long-term traders too as well. You got medium-term traders. If you're a long-term trader, I like to be all of them, right? I like to be all of them. I like to swing trade. There's medium to long-term. I like to scalp every once in a while. All right, but as of lately, I much prefer my personality trait goes to longer-term investing in swing trading. All right, so I think it's good to have exposure. Like if you are a long-term investor, right, you can take advantage of these deep pullbacks in the market and you can add to your retirement account, add to your portfolio. But to be successful in this overall environment while the risks are building, right, the stock market is rising, risks are building, you need to focus on more than just your trading account. I tell you, you know, while interest rates are flying up, if you have debt, right, personal debt, credit card debt, you know, you should take a break from the markets, focus on that, knock that down, right? It's just some nutty stuff going on right now, and you gotta focus on what works best for you and your personality type. Lumber's down 13.89% on the week. That's a big deal. We had the PMO starting to curl over too here. So is lumber going to all of a sudden recover? I don't know. This looks like lumber's crashing. Now, this is where it gets interesting. When lumber crashes, that could be a leading indicator also for housing. Okay? Why? Well, you know, put two and two together here. Why would lumber be important for housing? Okay, but also housing can be a leading indicator for the S&P 500, okay? And the reason why I've been showing this chart often is for a specific reason, and I'll show you here momentarily. So first and foremost, housing peaked out really in May of last year so far, right? So it actually hit a high right here. And then we haven't seen another high, really. We got close to it right here. Double top, S&P 500 put in another high. So this typically is a leading indicator. So it hit its high back here. Then the market started selling off, right? We saw a negative divergence, and we're seeing another negative divergence here as housing's falling. S&P 500 is going up, okay? Stocks like Lennar, home builders, right? It's been a lot of distribution potentially, or just chop back and forth, right? Volatility is the word that I was going for there. We had the MACD curling over. So home builders, home construction getting hurt, home improvement retailer. So Home Depot, right? Getting blasted right here to the downside. All right. Yeah, we might have recovery bounces, but this is where it gets interesting. If you follow Michael Guyad's work, the lumber to gold ratio, it's below 0. He calculates it slightly different. So I believe that we will be flipping to risk off this week. He publishes his stuff on a Tuesday. I believe it'll be risk off. It may not be according to his specific data, but nonetheless, this is relatively close for the most part. And I just highlighted, when the rate of change gets below 0, right? It doesn't mean that there's going to be a market crash, but it says, hey, there's some storm clouds up ahead. Let your foot off the gas. It could get risky. And you can see it crossed down here, and it warned us the 2018 crash. You can see here in 2020 it did the same thing. That was the pandemic. It even caught all the big crashes prior to this. And it doesn't always catch crashes, but it gives us that warning sign. And, the warning sign is here. Okay, that's one of them. And I'm showing you the other aspects of this too, like the lumber chart, the housing chart, and so forth. Now, this book right here, The Visual Investor, How to Spot Market Trends by John Murphy, is a great book. And I remember reading something about the housing market, and that's why I've been showing it so frequently. And I couldn't remember what book it was from up until Shay from my Discord channel pointed this out when I was posting these charts, and somebody asked, and I was like, oh my gosh, that's from The Visual Investor. So I want to take what he posted here because it's from the book, and it is a great point, and I'm going to show you some stuff from here. So I'm just going to read this page. So throughout 2007, one of the mantras repeated over and over again is the financial media was that the U.S. economy was still pretty healthy. If you remember back then, well, people were saying that, right? Economists, they claimed that the fallout of a weakening housing sector wasn't having much negative impact on retail spending or the rest of the economy. As a result, there wasn't much concern about the downturn in housing infecting the economy or the stock market. Unfortunately, visual analysis told us a very different story. Now, it's talking about a figure chart here. I don't have that picture, but I did pull up the chart myself, and I'll show you here momentarily. And I'll show you why it's important. Now, Shay highlighted a few things. So the peak in housing stocks during 2005 and their downturn in early 2006, which was clear on the charts. It was very clear, and it's clear now. It gave 2 warnings. One warning was that it was time to exit home building stocks. That had market leaders since 2000. A second warning was that the weaker housing sector could have negative implications for the rest of the economy. Okay? Now, if you want to screenshot this and read the whole thing, please go ahead and do so. He also highlighted down here clearly shows that housing weakness was infecting an important part of the stock market and the economy, and all the leading warning signs were clearly visible to the visual investor. And to be quite honest, I love being a visual investor because it's like a hack. It's like a cheat code, right? Now, what did the chart look like back then? Let me show you. This is from 2003 to 2008 with a great financial crisis. Now, if you haven't watched my prior video of 2008 versus 2022, go watch that. I'll try to remember to put the link in the description, but it also tells a good story. Now, if you look right here in 2005, what did housing do? Well, housing peaked. What did the S&P 500 do? Housing kept on going higher. So as the market kept rising, housing was giving us an indication that something was skewed. All right, and then you can see housing really started to sell off when we saw massive volatility before a stronger sell-off. And we all know what happened shortly after all of this. The market came tumbling down further. Now, I'm not calling for that to specifically happen, but we cannot sit here and ignore the data that's in front of us. Let's just look at this chart again. Okay, what is the chart showing me? Well, it's showing that the housing index peaked here in May, and we haven't got above that high. What did the market do? The market started ramping up higher. What's housing doing now? We're seeing massive volatility. Okay, so can this resolve itself? Yes. But as it stands right now, there is something big that's taking place. And it's not just here in housing and in lumber. It's in other charts as well. All right, so I hope that helps you visualize, maybe a bearish case scenario, or not even necessarily a bearish case or that a crash is going to happen, but to be aware and be mindful that when volatility is trending, people go crazy, right? People are going back and forth, it's going bullish, it's going bearish, the market's falling, and then you get thrown with these news headlines back and forth, and it gets crazy. All right, so we try to clear that clutter a little bit here, all right, as best as I know how to, which is, minimal, right? I'm no crazy professional. Now, the dollar, this is also interesting, right? The markets were up greatly, right? Big time. just ripping higher and higher. But what's so crazy to me is commodities are up, right? Some commodities, we're seeing massive volatility there. The markets are up, and the dollar is actually holding strong. Typically, you would think that the dollar would actually start falling down right here to help perpetuate a move like this, because that was the correlation. Has the correlation changed? I think it's too soon to tell. But what I do notice here is this is flagging perfectly, and it looks like it's getting ready for another move. Now, you got to ask yourself, if this starts breaking out, is this going to continue to perpetuate up? I don't know. I don't. But I don't like the chances of this breaking out further and this actually following alongside after a move already like this, because this is what I see. I see a strong move here. Strong moves typically get faded at some point or consolidate. Strong move, got consolidated. Strong move, could get consolidated. What I see here is a consolidation. And what I've seen previously here is on strong moves to the upside, S&P 500 falls. Strong moves to the downside, S&P 500 rises. So if this does break out into bull flag format, right, and it's a flight to safety trade, what's going to happen here? Let me tell you what I think could potentially happen. All right. First and foremost, we'll look at the weekly charts, but it looks strong overall. So market could extend further up. Say if it does, and then say if I'm right, or not necessarily right, but say if this works out. So we start to see a pullback, maybe around 50%. Boom, boom, boom. Now everybody, if we get that pullback, everyone's going to start talking. It's an inverse head and shoulder pattern. And that's what we'll be watching for, because the reality is, even if we're getting inverted yield curves, which we'll get into those soon, the market can still move higher. We can still rip up higher. So be on the lookout for that. I'm just trying to get a head start of this inverse head and shoulder pattern. The 11 sectors, if we look at them from a relative rotation standpoint, utilities, it's getting pretty stronger. Energy, still way up in that leading quadrant. And some big names right here, right, are still in that lagging quadrant. That's technology and consumer discretionary. Even though we're seeing them rip higher and higher, they're still well in the lagging quadrant. Now, yields, can't ignore this, right? Big, huge move in yields, all right? Which is doing what? It's just destroying bonds, right? Look at the TLT, just getting smashed. I would imagine going into Q2, there's going to be some point where we get some sort of relief here. I still believe that. I still have a small position, and I still think that we'll see some sort of relief here. Looking at this, and if the yield presses higher, all right, if the yield presses higher, I'm just shocked that this move has occurred and tech stocks have been moving alongside of it. And then the dollar's been holding. So things are very weird right now for me, right? There's no clear indication of something specific going to happen, because a lot of the correlations are something's askew, something's very crazy. The Fed's pinned in a very tight place, moving into a tightening cycle. We just hit 2.5, which is 2.5%. It's a very strong move, and yet it hasn't shown that at this rapid rate of change, we haven't seen tech and growth stocks really get hit. So be on the lookout for that, especially if this continues to perpetuate higher. And then when we take a look at the curves, all right, so these are all the yields, right? Not all of them, but there's some yields just for visualizations. The 10 and 2, it's at 0.18. Yikes. 35, it's down to 0.05. It's almost inverted. It is almost inverted after the FOMC meeting, poof, fell off a cliff. Now Powell was saying something, no, don't worry too much. We're gonna get out of this. But maybe. But this has been the best indicator, the most accurate indicator to let us know that a recession was around the corner. Whether that be, 1 year, 2 years, 5 months, 3 months, I don't know. But what I do know is this: when it inverts, which it seems like it will, it got to hold down there inverted for a little bit. All right, so you're going to get a lot of news headlines, a lot of things, but keep in mind, the longer that it stays inverted, the stronger this signal can become, okay? Now, if we take a look here at the yield curves, various ones, like the 10 and 3, it's inverted. The 10 and 5, it's inverted, and it's heading lower. We're sending multiple days down there. This is why it's telling me that we're probably going to see the 10 and 2 invert. And the 35 at this point, maybe, right? 10 and 7 and the 30-20 has been inverted. Now, the 10 and 3 is close to the 10 and 2, and this has been inverted. So my question is, okay, if we zoom out, when's the last time it was inverted? Well, it was inverted in 2007. It was inverted in 2006. What about the 10 and 5? The last time this was inverted was, well, 2006. 10-7, 2006. 30-20, it gets inverted quite often, okay? So if we take a look at the 10 and 3 and say, okay, well, what happened to the market? What happened to the S&P 500 when it inverted? Well, not only did it give us an indication that something was wrong, and not only this inversion here gave us a warning sign, but the housing market gave us a warning sign too. And that is why I'm pointing this out. What did the market do? The market went higher. It went from 2006, yeah, we had pullbacks in between, but it went higher. So you cannot rule out that the market is done moving up. You can't rule that out. But you can be aware that something is skew and you need to be very protective of your capital. If the market wants to continue to rip higher, don't miss out on those opportunities. But when the market does show pain, weakness, or something happens, don't ignore what's really going on behind the curtain. Nah, what I mean? If we take a look at the weekly chart of the XLF, all right, I'm kind of jumping around here, but I found this interesting. XLF. It's been making a little bit of a comeback. Why? Well, because of bonds, because of yields. They've been going up. But let's look at the volume profile. The move down, volume went up. The move up, volume went down. Still have wind at our face at the PMO, sorry. Price momentum oscillator. This is a negative divergence here in volume. Typically, you want the reverse. All right, so this doesn't necessarily mean anything bad at this particular point in time. It's just something noteworthy. So this to me, as the yields are rising and getting extended, they could back off, which makes financials a potential short opportunity. Let me dive into that a little bit deeper. Not this chart. I want to look at this chart. Yes, XLF on the daily time frame. You can see that volume, right, on the move down. And let's take, well, you know what? Before I told you everything on this chart, let me just show you the price action. What's the price action doing? Up, down, up, down, up, down, up. What comes up there? Up, maybe down. How far up? I don't know. But it's massive, massive volatility here. So the really only way to play this type of move is by at overextensions or play the channel, because that's what it's doing. These blue lines, that represents a channel. Sometimes we overshoot it. All right, so you short at the higher end, you buy at the lower end. Now this move up has been a big move up on that declining volume, which we talked about. Big move today, up 1.28%. This black line right here is the expected move, the risk range for next week. It's pricing in a dollar move. So if we get to the upper edge here and yields are rising, I think that this could be a potentially good short opportunity. Maybe even before it even hits there, at least to get some exposure just in case if we do see another one of these down moves after the up move. All right, so look for a hit lower, right? A break lower with increasing volume. That would be a distribution type day. So that is what I'm kind of paying attention to here. Now, another aspect of this is looking at the bullish percent index on the financials. It's also a little overextended, right? Boom, it's not quite over 70 yet, but the RSI is telling me that it is getting up there. Now I like to look for overextensions, right? Like right here, got overextended, started moving up. This right here was a positive divergence, and then the market started ripping up higher there too as well. Not the market, financials. Okay, and we're up there at that upper range. Let's hop into the risk ranges for the S&P 500. We closed within it, no surprise there. Next week, it's pricing in a smaller range. A little bit hard to believe, but that it's pricing in a smaller range. Whereas the upper range just over 460. So can it reach higher? Absolutely. Markets can act like this and they can do crazy things. But I will say there's resistance right overhead, right at around 455. And that could very well be some sort of area where we start to consolidate or we start to see some sort of a pullback. Like I said here, the previous trading day, after we closed on the low of the day, then we closed on the high of the day. To me, that looked like we're going to get a higher high and a higher low. That's exactly what we got. No surprise there. I don't really have an idea of what's going to be taking place Monday. If I had to guess, right, given the current price action, it could still continue its path of least resistance, which would be a higher high, higher low. This candle right here is known as a hanging man candle. All right, and it's a hanging man candle in the context, right, of a strong move to the upside. So if we start breaking below the low of that, that can indicate further downside potentially to that lower range. That lower range is right by that 200-day moving average. If we take a look at the weekly time frame, this looks stronger than heck, right? So we broke out of this wedge, bam, boom, boom, closing at the highs of the week basically. Now I will notice this big authoritative breakout, smaller candle means momentum is slowing. That can change, but just keep in mind that. And then also volume on the week just died. It just fell off a cliff. Okay. Let's continue on to the Qs. Q also a hanging man type candle, right? Or a high wave doji, dragonfly. I don't know. There's all kinds of names, but just understand strong move to the upside. Yeah, if we start breaking down that low 355, I would say 350 can be hit with ease, right? The upper range here is right around that 200-day moving average, close to around 370. Keep in mind, remember, the yields have been rising, and if those continue to rise, it's going to break this at some point. And very similar to what I said with the inverse head and shoulders, if this starts pulling down to the lower risk range, I think people are going to start saying, hey, yeah, look for this as an inverse head and shoulders. Okay, so that's what I'm watching for, right? I'm just going to be patient. I'm going to wait for the consolidation or a pullback. It's going to happen at some point. I don't care. Like, I do not care if it rips up to here and I miss that move. I don't care. If it goes from here to here, chances are it will be here again. And if it's not, I wait for consolidation regardless. I don't care about buying, at a low cost or a high cost. I care about buying at the right price. That makes sense to me, right? Me personally, right? I like to back into my risk. I want risk to be small and my reward to be higher than my risk. Take a look at the weekly time frame here. PMO still, wind at our face, but we broke out of that wedge. Strong, big bullish candle. We had some follow through. We talked about that in the last brief. Can this get another high? I mean, judging by the looks of it, why not? Unless something big happens over the weekend where we gap down, we just don't retest that high. But as it stands right now, it's not too far off of getting a higher high, potentially higher low there too as well. IWM, it's definitely the laggard of the week. It was basically flat. But I will say, it does look like it's flagging, like it can start heading higher here, right? Move to the upside, now consolidating on smaller volume. So if this breaks out, if we get stronger volume, that can be quite bullish, bringing us right to where, well, this resistance, this previous support, which then could become resistance, and it's also the upper risk range. So that's definitely a possibility here. We've been talking about the 15-minute time frame being a Wyckoff pattern, accumulation pattern that can fire us up. If that's a full measured move, people, boom, boom, and this flag breaks out to the upside, that brings us right to the 200-day moving average, right around that 215 to 217. So something to watch, right? The 20-day is flattening out. The 50-day is still declining. It can go either way for me right now. It's a bull flag in what? Bearish context, right? So it's hard to be, very determined on where that can potentially go. If we take a look at IWM on the weekly time frame, PMO is starting to curl over, but it is below zero, still bearish. We can see here, it's been trading sideways for a long time. Is this channel? Or are we just coming right back into the middle of this channel? We bear trapped us or bull trapped us. Is this just a longer bull trap? You got to wonder if this is a long period of distribution. Then we had that blow off top, so it's Wyckoff distribution or whatever. Our markets, like the hedge funds, if they unwound their balances or went through periods of distribution or whatever, are they really going to want to start accumulating? Right back where they took all this time to go into distribution mode. I have a hard time believing that. I'm open to the possibility, but when I look at lumber, when I look at the housing market, I need to see that turn around to feel a little bit more confident. You can see here, it's back above that 5-day. Still have curling over 30 and 40-week moving averages. Not the greatest look, right? Not the greatest look. All right, let's go ahead and hop into crypto before we do a quick word from today's sponsor, FTX. All right, so getting into crypto, yes, the buy signal still activated, still pointing up. Crypto's taking off right here. So far, so good. Can it reverse? Obviously, it can reverse. It has a strong correlation to growth stocks. So if growth does start peeling back, I think Bitcoin has a possibility of doing the same thing. But like I said, I just wait for the next sell signal. If I lose on the position, I could care less, right? You have to remove the emotion, right? If you have a strategy, if you don't have a strategy, you need one. But if a strategy and a playbook will help you remove those emotions, and hopefully, when it starts working out in our favor, we catch the longer runs. But in the meantime, protects us from more downside if it were to come. If we take a look at Bitcoin on the daily time frame, it did break out, put a little bit of a shooting star type candle in, right? Is this going to come right back in, a little bull trap, and expansion comes right back in, we start contracting some more? Very possible. We'll keep an eye on it, but as it stands right now, we're breaking out. Woo! And we have the moving average starting to curl back over too, which is positive. Ethereum also putting in a little shooting star candle as we reach the top end of this range. It's going to come back in here, and continue to contract. Maybe, maybe. Right now, I mean, it's very hard to determine. All right, we expansion, contraction. We had a strong move, like I've been saying about the tech stocks. If they pull back, it's likely to see this kind of stuff consolidate too as well. Ethereum to me looks pretty strong. I wouldn't mind getting into Ethereum, but I just don't want to get into Ethereum right now at this specific point. I got into Bitcoin on the breakout. I would prefer Ethereum to pull back just slightly, and I might take a position there too as well. But as it stands right now, I'm just happy in my current position in Bitcoin. All right, everybody, that's all I got for you on today's episode. We went over a lot. I ranted a lot. I hope you got something from today's episode. I don't have much of a recap other than just be mindful of volatility going into next week. I know the ranges are smaller, but that doesn't mean that it can't just creep its ugly little head right back up. We have some very interesting things taking place in lumber, commodities, just the yields, right? There's a lot of uncertainty here. So when volatility is trending, when it's above that 20, when it gets above 30, you're gonna seek comfort in confidence. And I tell you one thing, you shouldn't. Because anybody that's extremely confident in what's going to happen, eventually those people will be wrong. And if they're wrong this time or maybe a time after, it could really hurt somebody's portfolio. So do what's best for you. Do what's best for your personal financial situation. Have a wonderful night.